Are you ready to review real estate math leases? Well, get ready. Today or tonight, we're going to review leases, which is the second session of, sorry, I've got all these things going on here, so many websites and YouTube channels. All right, so per your request, I'm doing all the different sections of math. Well, you requested finance and other things like that. However, I'm going to review the different sections of math in the real estate prep book that I use. And today's focus is on leases. So let me show you the book that we use. So it's the Texas Real Estate License Exam Prep by the Mettling family, and Hamilton. There's a link in the description should you want to purchase the book, and Amazon pays me a little commission for it, just for your information, but it doesn't impact your price. All right, so let's get with it and review leases. At any time you have questions, please post them on the chat, and I will do my best to answer them. If not, we will Google them. So leases, we're going to start with percentage lease. And leases have to do with either residential or commercial, and even land, acreage. A lot of farmers lease land in order to grow crop instead of purchasing the land. And then rental leases for residential, rental leases for apartments, commercial, duplex, fourplex, you name it, all types of leases. All right, so leases. Percentage lease. So let me see if I can get this on one page here. Responding real quick. Okay, so leases, let's go on. Essentially, rent calculations. How do you calculate that? And again, I'm going to advise you, don't memorize formulas. Learn them, because when you go to the exam, you start getting stressed and anxious and trying to remember formulas. And I'll tell you what, our mind gets confused. So learn the concept. Practice some of them on your prep books and online. You can Google YouTube, YouTube, or also on Google and places like ChatGPT to ask for some examples of lease problems. So the formula, monthly percentage rent equals the sales times the sales charged. So example, a store generates $50,000 per month. That's a pretty good amount. It's a store, right? The lease calls for 1.5% or 1.5% rent. What monthly rent? So remember, yesterday we reviewed how to convert percentages to decimal. So we multiply by 100. We divide by 100. So you basically move the decimal to the left 2 places. So to the left of 1 is 1, and then another 1, you add a 0, so it's 0.15, as we see down here. So 50,000 times 0.15 equals $700 per month. And the lease calls for them to pay 1.5% of their monthly income. So $750 per month. The store generates how much? $50,000 per month. So make sure we get a rate of 1 month, and you keep the units. If they give you something like per year and they want an answer in months, you'll need to divide by 12, right? So those little things will trick you on the exam. One word will change the whole answer. So contracts for the sale of real estate. Percentage of listing price calculation. The formula, percentage of listing price equals the offer divided by the listing price. We're looking for the percentage, right, of the listing price. So an example, the property was listed for $300,000, receives an offer for $240,000. The offer's percentage of the listing price is $240,000 divided by $300,000 gives us what? 80%, or 0.8 in a decimal. And you will see this once you become a realtor and you see this on the MLS as to what percentage, or on the statistics, what percentage of the list price was the property sold at. Common throughout the US, it's about 95 to 97% of the final list price. When I say final list price, there could be some price reductions, new price. So it's from the final list price. I mean, this is quite a reduction. Okay, it was sold, the offer was for 20% less of the original list price, or 80%. Doing 240 divided by 380, it was 80%. The offer was 80%, or they offered 20% less, right? And why do I say that? Well, 80% plus 20% equals 100%. We're always dealing with 100. Earnest money deposit calculation. You'll be dealing with this on every contract that you write for a buyer. Is how much earnest money do they need to put down? We like to ask for the sellers, so that they see that the buyer is serious, 1% or 2%. So formula, deposit, the earnest money deposit that goes to whom? Title company, or be it an attorney, not given to the seller. It goes to the company closing the transaction. So the deposit equals the offering price times the required or market accepted percentage. The seller might require, they say, oh, I want 2% or 5%. They want a serious commitment, maybe because they've had other offers and they fell through. So now they want somebody that's going to be real serious and not fall out of the transaction. An example, a seller requires a 2% deposit on a property listed for $320,000. So what is that earnest money deposit? So the required deposit, assuming a full price offer, okay? Assuming, we know what that makes us a lot of times when we assume, right? But here they're telling us, assuming a full price offer is 320 times 2% equals 6,400. And it would probably be better to change it into a decimal point, the percent, which would be 0.02. Okay, so 2% of 320 is 64. So 2 times 32 is 64. And then you add 2 zeros. Why? Because we had to move the decimal point 2 points to the left. When we divide by 100 to go from percentage sign to decimal, we're moving back to 2 spots. So it's 0.02%, 6,400. So contracts, in order to be legal, require a consideration. Do you recall studying that? So the consideration does not have to be cash. It can be other forms of consideration. It can be earnest money. It can be a promissory note. They promise to pay at a later date because maybe they're out of state, out of town, or traveling. Or it could be a trade of a motorcycle, a car. That could be equivalent to the earnest money that is required. Okay, appraisal and value. appraisal get done? An appraisal gets done after, whenever there is a loan, the lender is going to require an appraisal. If it's cash, the buyer may not require an appraisal. However, I do recommend it. And if it's investors, they typically know what they're purchasing. Okay, they're more educated than a normal individual, a normal seller and buyer. So an appraisal is done after the option period, which means after the option period, that means the buyer either, or during the option period, the buyer does all their inspections and their due diligence. Should they decide to stay, let's say the option period is 10 days from the executed date, the date everybody signed and agreed, then they have 10 days. At the end of the 10 days or before 5 o'clock that day, they have to decide whether they're moving forward with the transaction or not. Should they back out, they get their earnest money back. If they do it definitely before 5 o'clock and the seller gets notified, right? Because everybody has to be notified. Should they continue on after the option period, then comes the rest of the research by the escrow company and the lender. The lender is continuously doing the work to, one, approve the buyer's credibility first. After the buyer's credibility, then they ask for an appraisal. After the appraisal, then is the survey. And after the survey, if everything is accepted, it goes to closing and signing. So at each of those points, we want to make sure we're not pushing the buyer to start spending money before it's due, because transactions do fall out of escrow. And who does the appraisal and the value? And it's still an estimate, right? It's an appraiser. Are they licensed by our state board? Not in Texas. It's a different board, not the Texas Real Estate Commission. So every state has different rules or who license them. In Texas, appraisers are licensed by the Appraisal Commission, not by Texas Real Estate Commission. So appraisal and value, adjusting comparables. So the rules to adjusting a comparable, which an appraiser will do, and even realtors, if they want to go into more detail on breaking down like how many bathrooms are there, is one comparable have more bathrooms or less bathrooms, you can add and subtract. So it says never adjust the subject. So the subject property is the one mentioned, the one for sale, the one that's under contract, right? So we never adjust its price. We adjust the comparable because it either has one more bathroom or one less bathroom. That's how an appraiser will go about it and determine the final price. So if the comparable, so a second rule, one, never adjust the subject property. Two, if the comparable is superior to the subject, subtract value from the comparable. So if the comparable is a higher end home, has more square footage, has more land, then that extra from the comparable has to be deducted from that comparable in order to get close to the subject property, right? Subtract the value from the comparable, not the subject property. Subject property always stays the same because we're adjusting the comparables to see if we can come up with a current market value based on the comparables for the property in mention between the seller and the buyer. The third rule, if the comparable is inferior to the subject property, we add value to the comparable. So if the comparable only had 2 bathrooms and the subject property had 3 bathrooms, or even realtors will add a bathroom price to that comparable. And when we do that to all the comparables, then we come up with a price to see if the offer price is higher or less. And if the offer price is higher than the comparables, the buyer may not want to buy that property, right? They're paying more than what it's actually worth in the market. That's when an appraiser will come out and give a lot of detail. They take photos, they take measurements, and it takes a little bit longer than realtors doing a comparable. Example, however, realtors can also do that type of comparable. It takes more work. So it depends if you're representing a seller, you might do it. But they're all estimates. Two different appraisers could come up with two different values. The same with realtors. It's an estimate. It's a guesstimate based on other properties that are currently on the market. So the subject property has a $10,000 pool and no porch. A comparable that sold for $250,000 has a porch, which is $5,000, and an extra bathroom, which is $6,000, and no pool. So adjustments to comp or 250, which is the comparable. So we're adding plus 10,000 for the pool, minus 5,000 for the porch, because the subject property does not have a porch, and minus 6,000 because it has an extra bathroom that the subject property does not have. So this brings a comparable value of 249,000. Okay, and the actual property, okay, it doesn't give us here. So that's how we're subtracting or adding. So that's one example. Adjustments to the comparables, right? Not the subject property. So gross rent multiplier. Okay, this is what MJ wanted to see some yesterday. So hopefully he's here or he'll rewatch. So a gross rent multiplier formula: sales price equals monthly rental income times the gross rent multiplier. The gross rent multiplier is a number, a factor to help investors determine whether they're making a good purchase or not. The monthly rental income equals sales price divided by the gross rent multiplier. Example: what is the value of a fourplex with monthly rent and of $2,800? Okay, let me drop that. $2,800 and a gross rent multiplier of 112. So the rent is $2,800 rent times 112 gross rent multiplier. That factor equals $313,600. So that would be the value, okay, of it has monthly rent of $2,800 with the gross rent multiplier of 112. Now, what if the gross rent multiplier of a fourplex with monthly rent of $2,800 and a value of $313,600? So now you're taking the price divided by the rent to find out what the gross rent multiplier. So you're just solving for a different factor, right? With the three factors in the equation: rent, the gross rent multiplier, and the value of the property, right? So here, sales price, monthly rent income times GRM, or monthly rent income. So you're just moving the factors around. So you're taking the monthly rent multiplier to the other side of the equation, or leaving that in the same place, pardon me. Bring in the gross rent multiplier to the other side. So you have sales divided by GRM. So here is sales price divided by rent instead of the monthly income. So once you do a few of these, you'll get to understand, okay, the rent multiplier. You have a sales price, monthly income, and then the gross rent multiplier. So gross income multiplier. So gross rent multiplier, then gross income multiplier. Let me oops. So the gross income multiplier, that formula is gross income multiplier, GIM. The other one was GRM, equals sales price divided by annual income. So now they're not looking at the monthly rent income. They're looking at the gross for the whole year. So when you see gross rent multiplier, that's monthly, right? It has monthly. So gross rent multiplier deals with month. Gross income multiplier deals with the annual income. So you keep those two. The formula is basically the same, just the numbers are a little bit different. The only thing that doesn't change is the sales price. So here we have the sales price divided by the annual income. So if here we had $2,800 rent per month, to get the annual, what would we have to do? Multiply by 12. Hi, MJ. Yes, he's here. So we would have to multiply by 12 in order to get the annual income. So the sales price, $313,600 divided by 2,800 times 12 to get the annual income, because this is monthly. That'll give us the gross income multiplier. So gross income is annual. Gross rent multiplier is monthly. So the sales price equals monthly rent income. So they're just moving the factors around. Okay. Oops. I'm going the wrong way. So here we had GIM, sales price over annual income. Here we have sales price. So it'll be annual income times GRM, or annual income equals sales price divided by GRM. Do you see that it's the same formula, just solving for a different thing? One is solving for GIM, the other one is solving for the sales price, and the third one is annual income. So they're solving for all three factors, okay? A, B, and C. Examples. What is the value of a commercial property with an annual income of $33,600 and a GIM of 9.3? So we have two factors, right? We have the sales price and we have the GIM. So would this be the formula? Because we have we have the annual income, pardon me, the annual income, and we have the GIM. So we're looking for sales price, right? So what is a commercial property with an annual income? Oops. So we're looking for, this one. The sales price equals annual income times GIM. So 33,600 is 12 months of income times 9.3 GIM gives us a property value of $312,480. So just keep in mind, the GIM is annual. GRM, pardon me. GRM is monthly. Oh, they put the wrong thing here. This should be, see, books make mistakes, just like people, right? Because they're written by humans. So this should be annual income equals sales price divided by GIM, the gross income, not rent multiplier, okay? Gross income multiplier. So make a note that this should be GIM, not GRM, because we're talking about annual income. And the question asked, what is the value of commercial property with an annual income of 33,000 and a GIM of 9.3? So if they wanted to do it monthly, then they would have to divide 33,600 divided by 12 and put the gross rent multiplier. Got it? What is the GIM of a commercial property with annual income 33,000 and a value of 312,480? So they're checking their work, working backwards. So now we have the price, which we solved here. The price for the property divided by the annual income gives us the 9.3 GIM. And it's not a percentage, okay? It is a factor. It's a income multiplier or rent multiplier. Okay, the cost of any questions on that? Because you were asking about that, MJ. It can easily be confusing. When you're at the exam is designed to confuse you, test you, get you anxious. I mean, if you're really confident about what you've studied, okay, it won't happen. However, it's their intent. They want us to figure things out, use our mind. So keep that mindset. Review the test from a test writer. Why would they be asking this way? Because typically there are 2 really good answers out of the 4, A, B, C, and D, right? So you can eliminate 2 of them right away. I'm a terrible multiple choice test taker, okay? I would get nervous and stressed. So don't feel bad if you do, okay? I have improved by doing this course, but I recently took a multiple choice test example to see how I scored. I'm still terrible at guessing. My guesses weren't very good. So there are strategies, okay, to use to get better at multiple choice questions. You can Google that, and I'll do a video of that later once we go through a lot of this information to prepare you for the exam. All right, the cost approach. Okay, so there are 3 different approaches to calculating the value of a property. Do you know what they are? If you do, type them in the chat. I'll give you a moment. Remember, there's 3 different ways to determine the value of properties. And you are correct, MJ, multiply by 12 if we're doing the annual. Nobody? Okay, so one of the approaches is cost approach formula. And another one, okay, they're not showing it here. So the cost approach formula is when there aren't comparables to the subject property, the appraiser is going to price the value of the land, the value of the building, and its amenities or features or accessories, right? So that's a different approach, a much more challenging approach than doing a comparable. And that's because there aren't any comparables within 1 mile, 2 to 5 mile radius, because we want every city has different prices. So we want to stay close to the subject property to come up with a value. So the cost of appraisal, they look, the value equals the land value plus improvements plus any capital additions. Okay, capital additions, they added equipment. If this is a farm to the building, they added a garage, you know, anything like that, minus depreciation, because the property depreciates. So the value of a property, we have the land, okay, the bottom of the building, any improvements, plus any capital additions that were made, minus the depreciation. And the depreciation will be of the building, not necessarily the land. So land is land, okay? It doesn't necessarily depreciate. It goes up or down because of the market. But a building, as it gets older, it's depreciating in value. And accountants will depreciate property for 27 years. So investors will get rid of them by the 27th year because now they don't have any write-offs, which is the depreciation, in addition to maintenance, operation expenses, and repairs. But depreciation won't happen after 27. And sometimes that can change. Sometimes I think it's up to 32 years. So an example here, we have land value equals $150,000. Home replacement cost equals $450,000. New garage added at $60,000, pardon me. Total depreciation equals $30,000. So now you're going to input all these values into the formula right above. So the value equals, let me bring that so we can see. Nope, didn't do it. Okay, so here we go. So the formula, value equals land value plus improvements plus additions minus depreciation. An example, the land value equals $150,000. The home replacement cost equals $450,000. So if the home were to get completely destroyed, burned down, insurance would pay $450,000. A new garage is added at a price of $60,000. Total depreciation is $30,000. So now put those values into that formula so that we can get what the value of the property is. So the value equals $150,000, which is the land, plus $450,000, which is the improvement. That's the home replacement cost, plus capital addition, $60,000, which is the garage, minus depreciation, which is $30,000. So that gives us a grand total of $630,000, the value of that property. Okay, MJ. Hopefully I don't have to take a bathroom break. But if I do, I'll put some music on. All right. Did you all get that? So that's the cost approach. You got to break everything down. I mean, I don't mean break the building down by bedrooms and bathrooms and all that. It's the land plus the improvement minus depreciation. It's basically three things: land, improvement, any additions, minus depreciation. Okay, so now depreciation formulas. So an annual depreciation equals the beginning depreciable basis. So when we purchase a property, we purchase it at a beginning basis. That's before doing any improvements. So we have a basis, okay, the bottom, divided by depreciation term, number of years. So how many years does the government allow to depreciate that for taxes, for a tax write-off? That's the advantage of owning property. So the property value is $500,000. Okay, the land value is $110,000. The depreciation term equals 39 years. So they don't give us the depreciation value. They give us 39 years. Okay, I said 27. When I had properties, they were depreciated 27 years. And this was back in the early 2000s. Okay, so step one is 500,000 minus 100,000, which is what? The land. Land is not depreciated. Remember that. Land is not depreciated. It's all the improvements that are depreciated. Equals 390,000. That's the basis that goes up here. Beginning depreciable basis. All the improvements minus, the whole property minus the land gives us the depreciable basis. Step 2. Now we have 390,000 divided by what? 39 years that property can be depreciated. So 10,000 annual depreciation. So that property, it's a $10,000 write-off every year on the tax return for that investor, for that owner. Capital equipment also, can cost thousands of dollars. My accountant used to depreciate some of my equipment that was expensive, large printers, and I had tractors, I had mowers because I had a lot of acreage. So all that can also get depreciated because those are considered capital improvements, assets. So income capitalization formula. So did y'all understand that? So in the prior question formula, they gave us the actual depreciation, right? They didn't tell us how many years. They just gave us the total depreciation for that particular year. In this one, we had to find out the annual depreciation. And they gave us the 39 years. Sometimes in the questions, they're going to give you more information than you need to confuse you. Pay attention to what the question is asking. Pay close attention. Here, they want the annual depreciation. So what do we need? The depreciable basis and the number of years. Okay, the income capitalization formula. Value equals annual net operating income divided by the capitalization rate, which again is a number. Capitalization rate, just rewriting the formula to solve for something different. Here they solve for value. Below, they're solving for the capitalization rate. Okay, so they move the capitalization rate over here and they move the value down here. So annual net operating income divided by value. Now they're rewriting it again. You can write it 3 ways. Why? Because there are 3 factors that can be solved. Annual net operating income equals value times capitalization rate. Some examples. 1, a property generates $490,000 net income and sells at a 7% cap rate. What is the value of, what is its value? Okay, so they give us property generates income. All right, so we have income. So that goes on the top. We're not solving for income, right? We're solving for value. So we'll put it into this formula. We have the annual income of $490,000. We have the cap rate, 7%. So 490,000 divided by 7% or 0.07. Convert that to make it easier, or on your calculator. So that gives us $7 million value. So the value of that commercial property based on a 7% cap rate is $7 million. So this is how investors, commercial builders and buyers calculate value when they're buying an existing property, and how the appraiser will value it. Excuse me, they will compare, they being the appraiser, will compare properties based on a cap rate and how much income they make. Those are 2 very important factors when when a buyer wants to buy a property. They want to know how much the income is, net income. So that's operating, that's gross income minus operating expenses equals net income, right? So 7 million. Nice property, huh? So 2, a property, a property has a net income of 490,000. Okay, so it has net income of that. We have that value. And sells for 7 million. Okay, that's the value. That goes down here, the denominator. What is the cap rate? Now we're solving for the cap rate. So when you have the formula in front of you, you just rewrite it according to what they're asking for. And here they want to know the cap rate. The other two numbers, operating income, 490 and 7. So 490,000 divided by 7 million equals 0.07 or 7%. So they're basically just solving backwards, checking their work. And we used to do that in math, or I did. All right, number 3, another example. A property's value is 7 million and the cap rate is 7. So now they give us the value and the cap rate. They want to know what is the net operating income. So this is what we're solving for. Net operating income. We have the value, 7 million, and 7% cap rate. So you multiply those two to get the operating income, annual operating income. If you wanted to know what the monthly operating income was, net operating, you would divide by 12, right? Okay, net operating income, NOI. That's the acronym. Okay, net operating income. So here was annual net operating income. And so here is net operating income, NOI, net income. That's after expenses from the gross income. So formula, NOI, net operating income, equals potential rent minus any vacancy loss, if they have any vacancies of apartments, plus other income. Maybe they have a laundromat or get income, be the NOI. No, NOI does not include debt payments. So property taxes, no, any mortgage payments, okay, is not included in there. Generating annual potential rent of 10,000 each. How many buildings, offices? 10. Renting potentially for 2,000 each. Vacancy is 10% of what? 10 offices versus what? 1 less unit. And annual expenses are 35,000. They have vending machine yields 5,000. So that is what is other income here. What is the NOI, net operating income? 100,000 is rent. So that's 10 offices times 10,000 each is 100,000. Minus they have a 10% vacancy. So 10%, okay, of 100,000. So 0.01 times 100,000, just move the decimal back, is minus 10,000. Vacancy plus vending machine, 5,000 other income, minus expenses, 35,000 equals 60,000. So they gave us the potential rent of 100,000. They gave us a 10% vacancy loss. They gave us other income, which was the vending machines, and they gave us the operating expenses. So that's how that is calculated there. They didn't show you, oh, multiply 10 times 100,000, okay, to get the minus 10,000. But you knew that each apartment is 10,000. They have a 10% vacancy. That's 1. Finance. Okay, so here's what you also wanted to see. Finance. So points. What is a point when it comes to mortgages, lending? Definition: 1 point equals 1% of the loan amount, not the list price. Okay, not the contract price, but of the loan amount, of the amount that the lender is going to loan, 0.01 the loan out. So the formula is points equals the fee paid divided, rewriting it, fee paid equals loan amount times points. So a borrower pays $225,000 for a $500,000 loan. How many points are paid? So what do we have? A borrower pays, fee paid, $25,000, and a loan amount, $500,000. So $25,000 divided by 500,000 is what? So you get rid of 3 zeros on the right-hand side. You reduce the formula to make it easier, at least I do. 25,000 divided by 500,000 equals 0.05, pardon me, which equals to 5 points. That's a lot of points. Okay. 2, in my opinion, a borrower pays 5 points on a $500,000 loan. So now we have the points and we have the loan amount. What is the fee? What is the fee paid? So 500,000 times 0.05, remember to convert 5% to a decimal, equals 25,000. Now, a borrower pays 25,000 as a 5 points on a loan. What is the loan amount? Go back here. They paid 25,000 and they have what? 5 points. Okay, 5 points. 25, so it'll be 25, 5 point. Borrower paid 25,000 as 5 points on the loan. What is the loan amount? 25,000 divided by, pardon me, I said multiply, divided by 0.05. Oops, let me go back. Amount, so the loan amount will go over here. And you've got the fee paid divided by the points gives us the loan amount. So make sure you understand what they're asking for in the exam and when you're studying your own prep questions. Whenever you're doing your prep test in your prep book or you go to a prep course, keep doing those questions until you get 100. If your answer ends up wrong and you keep going, you didn't learn the material. Go back and redo this test. Go back and review the concept, see why you missed it, and redo it so that you understand it, not memorize it. Rules of thumb. 1 point charge raises lender's yield by 0.125. 8 points charged raises lender's yield by 1%. So if a lender wants to yield 7% on a 6.5% loan, how many points must he or she charge? Okay, so they want to yield 7%, right, on a 6.5% loan. So they got 1 point charge raises lender's yield by 0.125. Right. How many points must he or she charge? So 7% minus 6.5% loan equals 0.5%. in this question. So lender wants to yield 7% on a 6.5% interest loan. So they're just subtracting that and the points that he or she charges, 0.5%. And so then, oh, pardon me, and then 0.5% divided by 0.125, because this 1 point charge raises lender's yield by 0.125, right? So the difference is 0.5%. So 8 points charged raises lender's yield by 1%, but here they only have 0.5%. We divide that by 0.25, that equals 4 points. So that lender, in order to get 0.5% more, must charge 4 points, right? 4 times 0.125 is 5, right? And so they'll end up getting their whole 7% instead of 8% here, which it says it raises lender's yield by 1%. Okay, interest rate, any questions on that? I rarely deal with this because I'm not in the lending side, right? However, it's good to understand in case our borrower asks, but I would say get that information from your lender. But this is for FYI, okay, to understand what the lenders do. So 4 points, right? So here, 4 points raise their yield by 0.5. Right? Because 8 points raises their yield by 1%. So 4 points raises their yield by 0.05%. Oops, excuse me. I'm sorry, 0.5%. I'm getting confused with the decimals and the percentage. Okay, interest rate, principal, and payments. Okay, you have a question. What is your question, MJ? Rate. I'm not sure what your question is. Oh, no, that was on the formula. Okay, well, how did we get 0.125? Okay, because 1 point, okay, so he needs to increase his yield by 0.5%. 1 point equals 0.125. You didn't have to calculate that. That was a given. Okay, 0.125 is equivalent to 1 point. Okay, so, but he wants to raise his yield by 0.5% instead of, so how do we get from 0.5%, I mean, from 0.125, which is 1 point, how do we get to 0.5%? Okay, because he had a 7% yield he wants, the lender wants, not he or she, on a 6.5% loan. Needs to find out how to get, what to charge the borrower for 0.5%. Okay, 0.5%, 7 minus 6.5. 1 point equals 0.125. So if he wants 4 points, it's actually 4 times 0.125 equals 0.5. So it's 4 points looking at it here. So it's 0.5 divided by 1.125% equals 4 points. So I look at it kind of like a pie cut in quarters. And so that's, how I do it. That's how you get the 4 points. Did we add 100? No. Okay. The 0.125 was given, MJ. Okay. And we didn't have to solve for that. So we had this information given. 1 point is half a point. 8 points is 1. So if it's half a point, it's between 1 and that. So half a point is half of 8, right? That's another way. Different ways to solve that problem. Okay. You got it? Okay, you got it. Okay. Interest rate and principal payment. So the formulas are, let me, interest rates in mortgage financing apply, is that kind of small? To the annual interest rate payment, annual interest payment and exclude principal payment. Interest rates don't include principal payment. If you've ever had a mortgage or a car payment, there's going to be the principal amount that reduces the amount of the loan you paid plus the interest that you're being charged, right? 2%, 3, 4, 5, okay? Remember to convert annual payments to monthly or vice versa as the question requires. Remember, I've stressed, pay attention to what units are being asked. And units would be monthly pay, or annual, feet, square feet, inches, yards, acres, those are units. And to exclude principal payments from your calculations when you're only searching for interest. So payment, okay, the mortgage payment is equal to the principal, which is the value that was financed, times a interest rate. Or principal equals the payment divided by the rate. Or the rate equals the payment divided by the principal. So the formula written in 3 ways to solve each particular factor. So an example, a borrower has $1 million loan at 6% interest. Darn it, have to remember not to go all the way down. What are the annual and monthly payments? What are they asking for? Annual, that's 12 months, and monthly payments. So the annual payment equals 1 million times 0.6, which is 6%, converted into a decimal, equals 60,000. So for the whole year, the interest rates are annual, right? They're annual interest rates, not monthly interest rates. So it's an annual interest rate. So you multiply the value times the interest rate, gives us 60,000. So 60,000 is what we're paying for interest for the whole year. And the rest of the question says they also want to know what the monthly payment. So you have 2 parts to that question. The monthly payment is now the yearly amount, 60 months, divided by what? 12 months, which is equal to 5,000. And even though you might be able to calculate some of these quickly in your mind, do it on a piece of paper or on a calculator so you visually see it and prevent any mistakes. So 2, a borrower has a $5,000 monthly payment on a 6% loan. What is the loan principal? Principal equals 5,000 times 12 divided by 6. And so why are they multiplying by 12? Oh, you got to 5,000 and got stuck. Okay, so why are they multiplying by 12? Because the percentage rate is for the whole year. And they're saying they're giving us 5,000 monthly payment. So we have a 6%, which is yearly, and we have monthly. So we have to make sure everything is yearly. So the principal is 5,000 monthly times 12 months divided by 6% annual interest rate. So 60,000 divided by decimal 0.06, which is 6%, equals 1 million. Pay attention to those units, monthly versus annual. It doesn't say here 6% annual loan, but interest rates are annual. Okay. Now 3, same problem, different answer they want. A borrower has a $5,000 monthly payment on a $1 million loan. What is the loan rate? Okay, so we have the payment, $5,000 a month. We have the principal, $1 million. So 5,000. We have to, but this is monthly, okay, on a $1 million loan. And we want to find what the rate is. So the rate is yearly. So we need to multiply 5,000 times 12 to get what it would be interest rate for the whole year, not interest rate, interest amount paid for the whole year on a $1 million loan. So it's 60,000 divided by 1 million to give us the 6% rate. Y'all follow me there? It's so easy to miss this type of question because right away it's, oh, okay, they gave us 5,000, divide that by 1 million, that'll give us the rate. And that's where we go wrong. This is monthly. This is annual. Need to get the units the same. Okay, so let me wet my throat. Okay, you got it, MJ. All right, let's total interest, interest rate, and loan term. Formula, interest-only loan, meaning on this loan, the owner is never paying any principal down. They're only paying for interest. These types of loans are typically used by investors who, these are kind of like ARM loans, annual percentage rate, annual rate mortgages. And they are going to do a construction. They only need it for 6 months or for a year, or they're only going to purchase this property for 1 or 2 years and resell it. So they don't want to have to pay down the interest. They want as little money out of their pocket so that they can invest their cash into the improvement, the building, the construction, all that. And so they use interest-only loans. Total interest equals loan amount times the rate times the term in years. So depends on how many years they're borrowing that money. Amortized loan. So amortized is what? It's normally amortized for the total term of the loan. Most mortgages are 30 years. So that's 360 months. And you get to see the difference every month of paying. Sometimes they're 20 years, sometimes they're 10 years. So amortized loan, total interest equals monthly principal and interest payment times 12 times the term minus the loan amount. Okay, so here they're paying principal and interest. Okay, pardon me, I said some of these interest loans, they don't pay any principal. And this one, they are. So the amortized loan is total interest equals monthly principal and interest, that's PI, payment, times 12 times the term, minus the loan amount. So example, a borrower obtains a 10-year interest-only loan. Okay, so it is interest-only, of $500,000 at 6%. How much interest will he or she pay? in those 10 years. So 500,000 times 0.06, which is the interest rate, times 10, which is 10 years, okay, equals 300,000. So that is the interest that they will pay in 10 years. Now, 2, a borrower obtains a 10-year loan, amortized loan, 500,000 at 6%, with monthly payments of $5,551. How much interest will he or she pay? Okay, 5,551 times what? 12, right? Because we got to deal with it for a year, because interest rates are yearly, times 10 years. Okay, so the monthly payment times 12 months times 10 years, minus the loan amount, which will end up being the amount of interest they paid. Darn it. So it is $166,120. Okay, we have a question here. On the real estate calculations, I got 2 out of 7 correct. Hopefully that will change after March 7. Yes, hopefully that will change. It's understanding how easily we try to solve problems real quick and forget about, is it annual? Is it monthly? Okay. And there's only very few questions for math, right, compared to the whole exam. However, they could make it or break it for you to pass. All right, so let's go to the next. Amortization. So did you all understand that? So make sure to convert to 12 months or convert to 1 month, because interest rates are annually. If anything, remember, interest rates are annual. Interest rates are annual. Remember my voice when you're in that exam. Annual interest rate, not monthly. Annual interest rate. Amortization schedule, calculation, pardon me. Formulas. Month 1, principal paid equals monthly payment minus loan amount times rate divided by 12, right? Because the rate is what? The interest. Month 2, the new loan amount after they subtracted that monthly payment of principal. So the loan keeps reducing every month by a little bit. So the new loan amount equals month principal minus the principal paid. Principal paid equals monthly payment minus new loan amount times the rate divided by 12. Anytime you see the rate, you're either going to divide by 12. Well, and not multiply by 12, but you're dividing by 12 because the rate is annual. So example, a borrower obtains 30-year mortgage, $100,000 amortized loan at 7% with a $665.31 monthly payment. That's the principal. No, I'm sorry. Forget I said that. Monthly payment. What is the principal paid in the second month? Okay. So when they quote this number, that's principal and interest, PI. And when we have a mortgage, most of the time, not most of the time, the lender will require PITI. What does that stand for? Principal, interest, taxes, and insurance. Here, we're only dealing with principal and interest. Okay, so a borrower got a 30-year loan, $100,000 amortized for 30 years at 7% interest. The monthly payment is $665.31. What is the principal paid in the second month? So month 1, principal paid $665.31. The original loan was for $100,000, times 7% divided by 12. So we're having 665. So we're looking to see what the monthly amount would be there in 12 months. So 665.31 minus 583.33 interest paid equals 81.98. So out of that whole monthly thing, only 81.98, okay, went to the principal. 583.33 interest paid. Once we own a property, less goes towards the interest. But at the beginning, with a high interest rate, the majority goes to interest. So month 2, new loan amount. It's 100,000, previous month beginning loan, okay, previous month principal, minus the principal paid 81.98, principal paid equals 99,918.02. That's the new loan amount. So an amortization schedule that is given to owners that get a loan provides this every single month. How much principal was paid, how much interest, and what is the new loan amount. They keep deducting that, and they show it for every single month, 12 months a year for 30 years. However, we can also calculate it. Now, if we were to pay an extra amount towards principal, that's going to affect everything else, because we have to remember to deduct the principal. So if we paid, let's say once a year, we paid $10,000 towards the principal because we wanted to pay it off quicker. Well, now the balance at that particular year is 90,000. Anytime we start subtracting the principal, then it's 90,000 becomes the basis whenever a large amount is paid towards the principal. So principal paid equals 665.31. So then that's for month 2, a new loan amount. Okay. So 99,918 times 7% divided by 12 equals 665.31 minus 582.86 interest paid equals 82.45. So see, the first month it was 81.98 that went towards the principal. The second month, $82.45 went towards principal. A little bit more because the beginning principal balance was 99,918, right? And that was the 100,000 minus the 81.98 that went towards principal the very first payment. Got it? So we start out with a basis of 100,000, multiply times the interest, divide by 12. We do that every month and subtract from the new loan amount and get what went towards the new principal. I mean, what was paid towards the principal. So every month this amount is going to go up. If you have some answers and you don't have time to calculate it, just know that the principal amount on the second month, the third month, and the fourth month are going to be larger than the first month and the second month. Each month, the principal amount is going to be a little bit larger, and the interest amount is going to be a little bit less. So here was 583.33. Here was 582.86. See, this starts going down, principal starts going up. Loan constants. So formulas: monthly payment, loan amount divided by 1,000 times loan constant. So loan amount equals monthly payment divided by loan constant equals 1,000. So they took the loan amount to the other, they moved the 1,000, multiplied it by that, and divided by the loan constant. Now here, the loan constant, they're solving. So again, they brought the loan constant to the other side, kept the monthly payment divided by the loan amount times 1,000. So examples. So the loan constant is the 1,000 number. Okay, that is a constant. It doesn't change. So a borrower obtains a loan for 1 million with a 6.3207 constant. What is the monthly payment? Monthly payment. Okay, monthly. What is the monthly payment? So this is what we're solving for. We have the loan amount. Then we have the constant. Oops. And divided by 1,000. So 1 million divided by 1,000 times the loan constant, 6.3207, equals 6,320 and 70. So the 1,000 is constant and the loan constant is a particular month. Sorry, so I said the loan constant doesn't change. The 1,000 doesn't change. The loan constant does. Pardon me. So they gave us the loan constant here of 6.3. Got it there? So make sure when you're looking at this, maybe write the formula down in a piece of paper, because I think you are allowed to have a piece of paper. They'll give it to you. And so that you know what numbers you're dealing with. So the constant number is 1,000. That doesn't change. The loan constant, they change. So number 2, a borrower has a monthly payment of 6,320. So now they're solving for a different part of that equation on a loan with a monthly constant of 6.3207. What is the loan amount? So we're solving here for loan amount. Monthly payment, we have the loan constant times 1,000. So 6320.70 divided by the loan constant times 1,000 equals 1 million. Now the borrower obtained, now they're solving for the other factor. Now the loan constant. They solve for the monthly payment, loan amount, now the loan constant. So the monthly payment divided by the amount, the loan amount, times the number that doesn't change, 1,000, equals the constant. So same equation, just solving for a different factor within that same equation, written differently. I'm trying to see how much. Okay, we have a little bit more. My throat is really drying up. All right. Here. Let me make that smaller. Okay, loan to value ratio, LTV. LTV ratio equals the loan divided by the price times the value. Okay, loan to value ratio. Loan divided by the price value. Loan equals LTV ratio times price value. Price value equals the loan divided by the LTV ratio. Same formula, just solving for a different part of the equation. Example, a borrower can get a $265,000 loan on a $320,000 home. Okay, so which one is the price value? $332,000, right? That is the price of the property. They're getting a $265,600 loan. What is their LTV ratio? So LTV ratio here, we have the loan amount, $265,600 divided by $332,000. So we get a loan rate of 80%. So that borrower is getting 80% loan. They're putting 20% down because everything comes from 100. So 80% minus from 100 gives us a 20% down. A borrower gets an 80% loan on a $332,000 home. What is the loan amount? So 80% times 320,000, $265,600. A borrower obtained an 80% loan for $265,600. What was the price of the home? Well, now we divide. We're looking for the value of the property on the contract. 265,600 divided by 0.8, convert the 80% to a decimal, gets 332,000. Any questions? Yeah, this formula sheet is on the book. So if you buy the book, okay, through my link, it's not that expensive. You will have all these formulas, but you cannot take them to the exam. I get it. Well explained. Good. So you can purchase the book that's in my link so you can follow along and review this with the book. Okay, review the video again with the book and stop the video when you don't understand and read the book. Read the concept when they explain about the math. And that's looking at the formulas here. So financial qualification. So how does a person qualify for a loan? Income ratio qualification. So formula, monthly principal and interest, PI payment, equals income ratio times monthly gross income. So example, a lender uses 28% income ratio for the PI payment. Some loans like FHA or VA may allow a higher income ratio. A borrower grosses $90,000 per year. What monthly PI payment can the buyer afford? So this is working backwards. So monthly payment is $90,000. Monthly principal interest payment, $90,000 divided by 12 times. So they've got the loan amount, right? I'm sorry, the income. They gross $90,000 per year. So their gross income divided by 12, because the lender is going to calculate it on an annual rate, right? Which is 12 months, times 0.28, which is 28%. That it showed here, the lender uses a 28% income. So 28% of their income is allowed to go towards purchasing a home. So that equals they can have a monthly payment on a $90,000 income, a monthly payment of $2,100. How much can the borrower? That's principal and interest. How much can the borrower borrow if the loan constant is 6.3207? See also loan constants. Okay, so then we're going back to the loan constant here, right? And the 1,000 stays the same, but the loan constant changes. So monthly payment, loan amount times 1,000, and they gave us the loan constant. Okay, so we have a loan constant here, 6.320. And how much can the borrower borrow if the loan constant is 6.3207? So we know that the 28% rate that the lender can use, they would have a $2,100 payment. So how much home can they buy? So the loan amount is what we're looking for, is $2,100 per month divided by the constant number, 6.3207, times 1,000. The 1,000 doesn't change. Equals, they can purchase a $332,000, $241.68 home. So that's how lenders calculate based on their income and constant factors like this 1,000 and how much they're allowed to loan, 28% in this case. And they use a loan constant of 6.307, 6.3207. Now, debt ratio qualification. Formulas, debt ratio equals the housing. So what do they allow for the debt? So the housing expense plus other debt payments, car, motorcycle, RV, boat, whatever, a quad, all those toys, divided by the monthly gross income. So housing expense, their monthly gross income times debt ratio, same formula. They just move the monthly gross income. Now they're solving for the housing expense. So we got to take the monthly gross income and multiply by the debt ratio. And then since it's a plus here, we're going to subtract it here when solving for housing expense. So monthly gross income times the debt ratio minus other debt payments is what the housing expense is. And that's a monthly housing expense. Example, a lender uses a 36% debt ratio in this case. A borrower earns $90,000 per year and has monthly non-housing debt payments, which is other debt payments, of $500, maybe a car payment. What housing payment can she or he afford? Housing expense equals their $90,000 divided by 12 months, right? Because we're looking at monthly expense, times the 0.36 debt ratio that the lender will allow, minus their expense, other debt expense of $500, equals, so 90,000 divided by 12 months, it was $2,700 a month, minus 500 towards a car, equals $2,200 a month. Okay, that's the housing expense. Okay, so yeah, so that's just the housing expense. So lenders are going to look at how much goes towards the home itself, operating the home for a family. And then what other expenses do they have? So sometimes they'll combine them and get a smaller rate, or without the other expenses, then they have a higher rate, debt ratio of 36%. That's minus any other toys, right? A car, motorcycle, RV, quad, anything else. Okay, I think we're done. We did 2 sections today instead of 1. So let's go to the sections here. So actually we did 3 sections. I was trying to do one of these topics per session. So I did leases, contract for sale, appraisal and value, and finance. So I did 4 sections. I'll change the title to the video so that it shows that we covered 4 different sections. And on the thumbnail, I put just leases. So any questions? So that means in an hour and a half, I covered 4 topics. So I could probably cover investments in a quarter of that time. So in like 25 minutes per topic. Should have been. All right. No questions. So I hope that was helpful, reviewing leases, contracts for sale, at appraisal and value, and finance. There was a lot to cover of different math topics in one session. Review this video again to understand it better. You can go fast, increase the speed on the sections that you're familiar with, reduce the speed where you want to understand it better. Should you have the book, I recommend, buy the book and follow along so that you can, a lot of times it's good to see the book. I have the book, okay? Because I will review the book, but I can't see, I have the book. So it's really something to go through it, and then you can read their detail in writing So some people learn better by text, others by visual and audio, others learn by just audio. So it depends on how you learn, which is best. Me, watch it over, review the questions over and over until I get 100 score, not just take the quiz once. You're very welcome, MJ. Thank you all for attending. And if this is your first time to my channel, please give me some support. Subscribe to my channel if you haven't yet. Give it a thumbs up if you enjoyed this, if this is helpful, and click the alerts button so that you get alerted anytime I go live. I'm doing these Tuesday, Wednesday, and Thursday at 6 p.m. I may add Saturday, but right now I'm doing 3 days and then a pre-recorded video on a different topic that has to do with real estate or YouTube for after you're a realtor. I am an active realtor doing transactions here in the San Antonio, Texas market. And I've been in 3 different markets: South Oregon, South Texas, and then now San Antonio. Yes, do Saturday. Okay, except I'm not sure. I used to do it at 9 o'clock on Saturdays. And so I don't know what kind of time would work for you all. I like a little bit later. I like to take my time in the morning, have my coffee, walk my cat, my neighbor's dog. So I like to do a noon session. Okay, that might work. I'll think about that. Okay. Thank you for mentioning. I love more of you participating. Come on, y'all. I used to have so many students. Sometimes I'd have up to 20 students when I was doing it almost 2 years ago, and interacting a lot. So we get to know each other. I get to understand where you're at, and you get to learn how I teach and whether it helps you or not. There's many other YouTube videos. Of course, I'd like you to stay with me, but you've got to go what helps for you. You can watch different ones and learn, see how it works better for you. Okay, you all, this is Wow Lillie Hendy coming to you from San Antonio, Texas with Agent Prep to help you prepare to take your exam and then get your real estate business going. Until next time, love you. Bye.